And welcome to Investment 360. In the hot seat this evening, Dwayne Kloppers, who's Head of Technical Solutions and Special Projects at Alexander Forbes Financial Services. Hi, Dwayne. Hi. We're talking about liability management when it comes to retirement fund management. I suppose everyone has to manage their liabilities, companies and so on, but there's a specific meaning to this term. It's a neglected area of retirement fund management. Set the scene for us.
Correct. I think you speak to an important issue here. The recently released Regulation 28 speaks of a fund choosing assets which are appropriate to its liabilities, and that's something we really try to unpack, in particular in the defined contribution arena. That's really the kind of organ or vehicle that most members in South Africa use. What exactly does that mean? It's perhaps not immediately obvious, so we've engaged a little with the FSB, and really the conclusion that we've reached jointly is that really members have a reasonable expectation when they're retiring to replace a certain amount of their income. So what we really need to...
But that's what the whole thing's about,
correct,
isn't it?
Correct.
Yeah.
So what we're talking to at the moment is really placing a greater focus and a closer management towards what we're calling a liability or an implied liability, which is really meeting your income requirements in your retirement period, rather than focusing exclusively on returns explicitly only.
Is this a question of rewarding the wrong behaviour and the right behaviour among the people who run these funds? Because if it's rather like the banks, you know, if you're giving home loans and you say, we want you to develop market share in home loans, you're going to have the bank's managers giving lots of home loans. If you say we want to keep the bad loans down and you're going to be judged on that, well, they'll give less loans. So if you're rewarded for returns, how does that undermine the other duty, which is to manage the liability?
Quite right. It's, again, an interesting question you pose. We did some calculations and a bit of a study, and what we saw is that between 2001 and 2011, although there was strong equity performance across that period, we had a situation where a member who was, say, aged 30, who could look to retire on about 75% of his salary when he reached retirement. In 2011, that same member was probably looking close at 63%. And this is an interesting encumbrance of income. Why is that? It's really other factors, for example, interest rates, which have fallen significantly. That really reduces the income that member can expect in retirement. And that is quite a problem. And it's exactly what you speak to. We've been focusing very closely on the return element of that, but there's really a second component to that. The main component being how interest rates change, longevity, that sort of thing. And we are proposing that there really needs to be a much closer monitoring of that, incentivization or restrictions to try and manage closer towards that, both in terms of monitoring and prospectively how one structures a portfolio.
Right. Dwayne, liability management has been a word that I've heard for decades now, but I haven't seen much applied in practice. I really haven't. Maybe a few defined benefit schemes have had liability management, and they essentially, and this is being very simplistic, essentially all they did was buy ILBs, inflation-linked bonds, and they said that's liability management. Where do you think this is going to go to in 5 years? Are we going to get it by individual in a defined contribution scheme, or will the bigger funds do it in general? And are there enough assets, liability type assets, to actually go around? Because I know inflation-linked bonds, this is not a big market.
So two elements to that question, and the first one is that concept of moving into linkers or swaps or those sorts of assets which match your liability. Now, a point I want to stress is that we're not talking about de-risking. What you're mentioning is really LDI in the space of defined benefit funds, where the focus is to remove risk. Yeah, we're not necessarily saying remove all risk. We're saying, well, you probably need those growth assets, but let's just monitor how you take those risks on relative to your liability. So that might involve a component of inflation-linked bonds. In your lower risk portfolios, there's going to be a greater focus on linkers instead of cash. For example, some of the studies we've done show that in a low risk portfolio focused on your liability rather than just a capital sum, there you're looking at more likely something like a 76% allocation to inflation-linked bonds rather than a 48% allocation if you were focused purely on returns. So that's a big difference. Your point is valid. Are there the assets to support this? Well, the points I made, it's not just about investing in de-risking instruments, it's about investing more smartly when you take on that risk.
In your statement, Dwayne, you talk about the financial services industry doesn't really have a category of service provider known as a liability manager. As Wayne says, we've heard about it for a long time and you haven't seen it in practice. not likely to see it in practice if no one is given responsibility for it.
Correct. I think it's an area we want to develop on, entrench that more as a role. I think the basics or the armature of it is there. There has been practice in terms of defined benefit funds, that de-risking, that thinking is out there. There's also been a basis of fairly strong asset consulting in the country, I think, but we're really driving towards a closer focus, more regular monitoring of your strategies relative to your liabilities.
You pose a question here in your statement. What is missing in simply buying a best investment view solution? That's the question you pose. What's the answer?
It's interesting. There's two approaches which get questioned often relative to this: best investment views and absolute return portfolios. Best investment views sometimes do have a place in retirement funding. They can spur on a lot of growth and accumulation of assets, but again, one needs to be measuring those risks relative to liabilities. Now, it's interesting when you pass those assets onto an investments manager, he's really benchmarked either against a peer group type of benchmark or against a return-based benchmark, an index-linked benchmark, and that really doesn't focus on your liabilities. That's fine. A manager needs to be judged on his skills in terms of the market, but somebody needs to step in and monitor relative to liabilities, and that's the additional role we're calling for. The second illustration that I mentioned was really the absolute return portfolios. I think that's been a second mechanism where some people have believed they're targeting their liabilities more than they are. The idea being that if you can achieve a certain CPI plus target, you could reach a certain retirement level. Again, that doesn't take cognizance of things like annuity rates. So again, there's that need for that additional check. It's really two sides of how you're progressing to your retirement funding: how well your assets are performing, how well your manager is doing in terms of his skill set, but then equally the other side of the equation, how your liabilities are developing and who's looking after that.
Practical implementation, you say it's surprisingly easy. There's software that's available. Let's say that someone who hasn't thought about this in the way that you're proposing now starts thinking about it. What will they do differently?
I think it's really about engaging with your asset consultants and engaging to make sure that somebody is managing this. In some funds it is the case that it is being managed, but I think in some of the smaller funds it isn't. Sometimes just an off-the-shelf portfolio is selected. I think there's a few elements to it. It's about monitoring your performance on an ongoing basis, so looking back at your historical performance relative to your liability and market indices, so making that distinction, those two judgments, and then really also paying enough attention to processes like asset liability modeling to make sure that you are going to adequately reach those targets, and doing that frequently enough, and making sure, importantly, that there are controls in place that will highlight when your strategy has deviated. So it's all good and well to go through that process and say, well, on a prospective basis we believe we're going to get there, but do we have a control in place that says to us, hold on, things have changed, we need to review that strategy. Last
question for you now. Practice in South Africa, practice overseas. I mean, people often say that our industry is among the most advanced in the world. Certainly there's a great deal of thought going on about how to improve it, and legislation and so on. We have, on the one hand, a very competitive industry. There are other allegations that the costs are too high and so on. But certainly we've got a lot of people thinking about the way things are done. So how do we compare in this area to the United States, Europe, and places like that?
I think historically we've held a monopoly in terms of development or innovation in the DC space, and I'm confident that we can continue to do that. The United Kingdom has caught up quite a bit, but I think there's still a lot of excellent thinking coming along here, and I think that we're still very much a market leader internationally in defined contribution space.